Hello and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, the World Trade Organization has cut its world trade forecast, as manufacturing slowdown does seem to start, and this comes with new economic data, as well as that UK construction activity plunges, which the industry survey did show yesterday. But we've got lots to talk about in the charts also, lots happening just across all markets, and we've got lots of data coming out today with the important NFP figures coming out this afternoon, so make sure you stay around to the end for when we're going to talk about that and also come to the charts. But firstly, to talk about really, of course, is the World Trade Organization. Now, the World Trade Organization has halved, its estimate for export growth around the world this year, and this comes as manufacturing industries are being hit by a slowdown and rising geopolitical tensions. We talked about this, this element of geopolitical tensions affecting trade and economies a lot recently, and this is largely in play to do with the China and the US, global trade battle, whereby the US is now, and has, banned many forms of investment into Chinese companies and into certain sectors of the Chinese manufacturing sector, as well as that, China has had its own issues, with manufacturing as a result of a slowdown coming out of the COVID lockdowns, and this is all weighed on supply chains, and Messi was a large globally trade commodity, and that kind of declined off the back of that, as well as the products the West would send to Russia and Russia would send to the West, and so that's all seen a decline. Now, the World Trade Organization yesterday said it expected the volume of world merchandise trade to only go to 0.8%, grow by own expectations and forecasts of trade growth. And you would be expecting that coming out of kind of things like COVID and other kind of more geopolitical issues such as the Russian invasion into Ukraine, as we're kind of distancing ourselves from that, sadly, you would kind of expect people to start picking up global trade a bit more. However, it is expected that was a cause for concern, and the adverse implications for the living standards of the people of the world were obviously in grave danger. As when these global trade slowdowns occur, obviously you're hurting thousands upon millions really of people which rely on certain global trades for their income and just for their survival, such as food trade. And we saw this export of grain, and this was hurting large African nations which relied on grain for their food production. And so kind of seeing how these geopolitical effects are really having a great deal on the standards of living of so many nations, it is quite worrying. Now, the World Trade and she also commented on the global economic fragment issues around more economic isolationism, and we've heard a lot of Republicans in the US kind of calling for more of this. This kind of came out the back of kind of isolationist policy decisions with Trump, as well as the more isolationist movement of Brexit. And also, if we think about Biden's more kind of sanctions on Russia, as well as his issues and sanctions on investment of isolationist policies which are reducing global trade. And this is a worry for the World Trade Organization, which obviously depends and supports this kind of globalized trade world. Now, the World Trade Organization said the share of intermediate goods in world trade, which is an indicator of global supply chain activity, fell to 48.5% in the first half, with this being down from the average of 51% over the previous 3 years. Now, the share of bilateral partners in the US in parts and accessories also fell to 38% in the first half of 2023, with this being down from 33% in the same period of 2022. So as we can see there, a significant change in the areas of trade and the levels of trade of commodities and products and that sort of thing. With the World Trade chief economist Ralph Osser, however, did say that the global, the broad deglobalization was not here yet. So we're not actually seeing the effects of that just yet. We may see that later on, however, He did, however, comment on the point that the amount of goods produced through complex supply chains has plateaued in at least the short run. And so, this is a worry, obviously, because, these complex supply chains are obviously important to the world's global economy and all the trade networks that exist. With the World Trade Organization also downgrading, at this time where there's been a slump in goods exports and imports off the back of which began at the end of last year. So this is all kind of culminating following that kind of fall in exports and imports, which we were kind of seeing at the end of last year. And we could attribute this to many things. Obviously the Chinese sector having some issues, as well as rising borrowing costs, reducing demand, and reducing the ability to produce. So it's kind of unsurprising to start seeing this now. The impact of high inflation and high borrowing costs in many advanced economies, as well as a strained property market in China, has largely been to blame for this falling global trade, as I said, with the slowdown being reported to be involving a large number of countries and a wide array of goods, with manufacturers such as iron and steel, textiles and clothing being part of the broad category of items. North America, however, is still expected to register the strongest growth, and Asia is reported or at least expected to perform the best in 2024. So it's not all doom and gloom, but it is looking a bit worrying for global trade at the moment. But next article to talk about, really, of course, is the fact that UK construction companies are in a tough situation at the moment, with UK construction activity plunging, which the industry survey did show, with UK construction activity having the largest decline since May of 2020. So a very long time since we've seen this larger a fall, which is obviously very worrying for the UK construction industry, but also the housing market and the instability that this may create. And this came as a result of the downturn in house building, leading to a greater than expected fall in September. In contrast to a forecast of the 49.9 index figure on the S&P Global UK Construction Purchasing Managers Index, the index instead posted a figure of only 45. So, coming in nearly 5 points lower than the forecasted figure. And this is even further down from the 50.8 figure in August. Really poor data showing for the UK construction industry, and it really does provide a worrying message for what may be coming for the UK's housing market, as well as just the general UK construction industry. This provided extra with the most recent figure indicating contraction, obviously, because if it's coming in below 50, this is a contraction, and this provided extra evidence that higher interest rates are now finally weighing on the UK's demand. And all this data furthers the idea the rates will stay at the 5.25% level at the November meeting, because obviously we've been talking about the Bank of England and their rate policy a lot recently, and this has largely been situated around whether they should raise rates further from the 5.25%, or in fact they should keep them where they are. Now, Prior to the last meeting, we know that we did expect, a rate hike, but following that inflation data, which showed that inflation was actually looking better than expected, the Bank of England did not raise rates any further, as a result having, its effects on the pound, but also, this kind of element of the UK construction industry declining despite not raising rates does also weigh on the Bank of England to probably not raise rates any further, because if rates do go up any further, obviously this is also going to weigh further on the UK construction industry, and having so many adverse effects on the economy as a result of higher borrowing costs is bad for the political side, for any parties or the Bank of England, but also it's just bad in general if you're hurting the economy for no good reason. With construction companies blaming the data on cutbacks to new residential development projects as a result of sluggish demand and high borrowing costs. And this is not surprising to us, considering rates are near highs not seen for 20 years or so, and now we're kind of seeing the kind of fall in demand as a result of that, because people just can't handle the borrowing costs, with businesses in the residential sector performing the worst, having a reading of just 38.1%, with this being the steepest downturn since April 2009, excluding data in the coronavirus pandemic. So serious declines that we're seeing here, very large differences to what was expected, with commercial and civil engineering activity also being down. And all this data obviously comes just after a day of the announcement of the axing of the northern part of the HS2 line. As we spoke about a lot yesterday, Rishi Sunak has now committed to cancelling the part of the HS2 line which would run from Birmingham to Manchester. And obviously this is very significant, because you have to think about how many contractors, how many builders, civil engineers, all of these people were engaged and hired for this project, and now cutting such a significant line which would have cost $36 billion or so, pounds, cutting that kind of line, that's all money that would have gone to the construction sector largely, and now it won't go to anyone. It will go to the other areas which Rishi Sunak has committed to, but it won't go to the original areas and construction industry which it was expected to. So it'll be interesting to see how this weighs on the UK's construction industry as a result, with companies also with this undoubtedly derailing of the pipeline of future activity for many contractors and their supply chain. Sorry, I kind of said that a bit poor, but essentially it was a quote from a leading economist in terms and in relation to the fact that derailing this pipeline for future activity which HS2 would have enabled will obviously hurt contractors and the supply chain, with companies also predicting that wages would increase by 5.2%, and this is up from 5% in August but down from 6.3% in December of 2022. So obviously these higher wages are going to weigh on the costs which are already rising for these construction companies, so it won't be surprising to see a downturn in that industry. The Bank of England data also showed that businesses were finding it easier to recruit workers, with 55% reporting it was little or much harder to find new employees. But that's all for the articles really. It'll be interesting, so keep your eyes on the UK construction industry as all this data comes out, and after the HS2 line has been cancelled from Birmingham to Manchester. So it'll be interesting to see how that affects the industry. But that's all for the articles. Obviously, moving on, we have the US indices to talk about first on the charts, with US indices largely consolidating, as we can see here. We did talk about how it had reached this minus 27.2 Fibonacci extension level, and we were kind of commenting on how will it continue below that, break lower, or will it kind of use that area for a buyback and kind of head higher, maybe to another area to retrace from. However, we're kind of seeing not really a retracement, but more so of a consolidation and accumulation. This is kind of unsurprising to us, considering the data that we've got coming out today, and that being the NFP data. And obviously NFP data weighs heavily on the Fed's decision around raising rates or not, as this is the US unemployment and employment data. So obviously it's very important to the Fed in understanding how the economy is handling the current rates. As well as that, it's going to affect US indices, because whatever the Fed does, obviously is going to affect US stocks, which make up US indices. So that's why we're kind of seeing this consolidation across US indices, with kind of the Nasdaq being more volatile at the moment, surprisingly. But yeah. Moving on from that, we have the dollar to talk about, which is in an interesting position moving into NFP today, with the dollar declining, obviously, and now nearing this 61.8% Fibonacci area. It'll be interesting to see whether, with NFP coming out today, it will bounce off that in preparation, or in fact, it will continue lower until we kind of reach this trend line on the dollar and the 78.6% Fibonacci area. And I would find it unsurprising, for it to make its way down here just in the lead up to NFP, as it does seem, the short orders have been placed around this area, and so they're probably looking for some liquidity, waiting for NFP so they can get their buy-in orders as well to hedge their positions on the dollar. So keep your eye on the dollar as we go into NFP, because the dollar will move greatly following this data release. As well as that, we've got Euro USD, so still on the topic of the dollar. But interestingly enough, this bearish movement that Euro USD has kind of been engaged in for some while, it's still, still in that area, I guess, because it hasn't broken above this prior high. But that said, it has broken out of this trend line, this bearish trend line that we can see here, touching twice, and it has seemed to have broken through. We did comment yesterday, maybe it will touch it once more from the 50% area before continuing lower, but it does seem accumulated before moving higher. So maybe it will make a move of this 61.8% area, maybe even liquidating, the short positions that were held above this trend line, as people didn't expect it to go above, and so maybe banks are trying to gain the liquidity, their short positions, in advance of the NFP data coming out today. So it'll be interesting to see the result of that and how it will affect Euro USD, which has commonly been on this bearish trajectory for some time now. So keep your eye on Euro USD. Next to talk about really is gold, which is consolidating in line for NFP. Now, generally the consensus is, when dollar goes up, gold goes down, and when dollar goes down, gold goes up, and this is because people often use gold as a hedge against the dollar. That said, in preparation for NFP, once the dollar has declined, gold has stayed where it is, and in fact it's accumulated around this area of liquidity that I did highlight some while back. This kind of area where it almost double bottomed, but at least there was a lot of accumulation of buy orders before it made a strong push and rally to the upside, and after the steep decline following the Fed's rhetoric being more hawkish a week or two ago, we have seen that decline in gold falling to this area of liquidity, where it does seem to be accumulating buy and sell orders, as we can see here, with lots of wicks to the upside and lots of wicks to the downside, but not really going anywhere and moving to the side. So it'll be interesting to see how gold will react to this NFP data, so keep your eyes on gold, obviously, and I've highlighted here the Fibonacci extension tool. So it'll be interesting to see, if gold does continue to the downside, if hawkish data does come out, whether, it will come up first in line with, the market clearing, there being, no liquidity, and so moving like crazy to try and find an area of liquidity around these Fibonacci areas. So keep your eyes on that. As well as that, and finally we have our oil, which, despite, the more fundamental news around, oil being in a very positive position as a result of Saudi Arabia and Russia cutting their oil supplies, or at least extending their cut of oil supplies, whilst it took quite a few weeks for maybe even a month for oil, to climb up to the highs of $96 a barrel. In only a few days has oil fallen off and has now reached areas such as $84 a barrel within just a few days. So oil is in a really tough spot. I did highlight out this area of liquidity, which I did say it was having some interaction with, so we were interested to see whether it would move off there, but it does seem that had no effect and it is continuing lower. But there is a strong area of liquidity around this level, this wide area of liquidity, so it'll be interesting to see whether this will have some interaction. As we can see, this has been an area of prior accumulation with lots of wicks extending into there before buy orders, and this being the start of where oil made its rally to $96 a barrel. So it'll be interesting to see how it responds to that, and maybe even respond to the data coming out today. But that's all for the charts. Of course, now considering we've got NFP coming out today, we need to talk about the economic calendar. So Japanese household spending is coming out today. As well as that, we've got Swiss unemployment data coming out today, with unemployment rate being released. As well as that, we've also got Canadian employment data. So on the same day as NFP, we've got Canadian employment change as well as unemployment rate, and this is NFP. No, not NFP, but this is their unemployment data. As well as that, and most importantly, we have United States non-farm payroll. So this is how many people are kind of employed or added to employment, added to payroll, that are not employed in seasonal jobs such as farming, which is obviously seasonal, and so the employment data isn't as useful. This is very pivotal in the Fed's making in the Fed's policy making decisions. So keep your eyes on NFP. We're expecting 170 jobs being added, as well as a forecast unemployment rate of 3.7%. With average hourly earnings year on year going up by 4.3%, and average hourly earnings going up month by month by 0.3%. So keep your eyes on that. That'll be very important. And as well as that, we've also got a Fed official's speech today, so it'll be interesting to see how he will respond to that figure in his speech possibly. And as well as that, we've also got US consumer credit change, so keep your eyes on that, of course. But that's all for the articles, that's all for the charts, and that's all for the economic calendar. Hope you have a great trading day. But that's all from us from Wildwood Capital. Have a great weekend. Keep your eyes on AFP. See you later. Bye.